I'm Dan Passarelli of MarketTaker.com here on the floor of the CME Group. Well, in our MarketTaker Live Advantage group coaching class today, our head coach was looking at some trades. Now, he came across one that I think is a great one. It's in United Airlines, symbol UAL. Take a look at a chart of you all, and you'll see that the stock is kind of waning. It is below all the relevant moving averages, and it is coming up to a downwardly sloping trend line, which it has reversed off of a number of times in the past. So I would be bearish on this, but the question is, how would I play it? So when there's stocks that are making a rout, that are heading lower, I don't like to limit upside in situations like that. That is upside profit potential. So I would rather just simply go out there and buy an outright put instead of trade a spread. But in order to feel confident about that, what I first need to do is look at the implied volatility. Now, the implied volatility in you all right now is pretty low. So the options are indeed cheap. So I don't really have to spread off that implied volatility risk. So I'm okay just going out and buying a straight put. The trade that I like is buying the July 47 puts at $2.60 or better. Now, this would probably be a reasonably short-term trade for me, maybe a couple of weeks. However, I'm buying the July. The question might be, well, if I'm only going to hold this trade for a couple of weeks, why would I think about going out and buying a much further out option like July? And the answer is simple. It's because of the time decay, theta. Longer term options have lower time decay. Every day I hold on to this trade, if the stock doesn't fall, I can lose money based on that time decay, on that theta. So I want to limit that cost of doing business and make it as low as possible. So I go out to the July. Now, why not a spread? Well, again, because the implied volatility is so low and I don't want to limit my profit potential as the stock falls. So I simply go out there and buy an outright put. Now, what happens if I'm wrong? What happens if the stock busts up and breaks through that downwardly sloping trend line? Well, if we have a breakout scenario like that, I sure don't want to be holding this put and risk losing the entire $260 that I pay for it. So I would cut my losses early. What I would do is I would set a stop loss of about 50 cents. Can vary per trader where exactly one would set their stops, but I think 50 cents is about right in this type of scenario with the liquidity that are in these options. This is Dan Passarelli here on the floor of the CME Group.